For more on a potential recession, let's bring in Joe Livornia, chief economist at Natixis. Joe, great to have you with us.
Thank you. Great to be with you guys.
Where do you peg the probability of a recession?
Right now, it's let's say by year end, I'd say about 50-50. It's pretty close.
50-50. How about this argument that the consumer, is flush with cash? They're sitting on savings. They've got good jobs, rising wages, and so they can weather inflation. The economy can actually do okay.
Melissa, I don't believe that. I mean, Tim made a good point about consumer expectations. They're in the mid 50s, and typically that's associated with recessions. The cumulative saving argument doesn't really hold up because the savings rate is a flow, just as GDP and earnings are flows. The savings rate is back down well below its pre-pandemic level. And the problem for the household, Melissa, is going to be a massive amount of demand destruction from higher food and energy costs, coupled with surging shelter. That's over 50% of essential spending. The reason I say 50-50 is there's always a chance we get some sort of diplomatic resolution in Ukraine, God willing, and that could moderate some of these food and energy costs. But the longer that crisis continues, the likelier those recession risks go, and we'll have a recession by year end.
Hey, Joe, it's Karen. Thanks for being on. If you had a magic wand or you were the Fed chair and you were tasked with avoiding a recession, what would you do at this point, or is it too late?
The yield curve would tell you it's probably too late. But what I would do is I'd get to 1%. I'd scrap the dots. I'd get rid of this idiotic transparency. The Fed can't predict anything, and go back to a more Greenspanian approach, which will never happen. But I would raise rates, see what happens, and then if the economy was okay in the back half of the year, then you could go to 2%. I would take it more as a step function. They're not going to do that, or they're not saying they're going to do that, Karen. They're going to raise rates 7, 8, 9 meetings in a row, according to some people.
You mentioned, if the conflict in Ukraine gets resolved, Joe, and I'm wondering how you think about rising prices and inflation in so many different commodities, and the resolution of this conflict as it relates to sanctions being lifted. If the conflict is resolved, sanctions may still not be lifted, and we may still feel those same inflationary pressures.
No, that's exactly right. And you'll come back to the Fed still wanting to raise rates because it believes it's behind the curve, given how negative real rates are. But if there is a diplomatic resolution, at least you wouldn't be worried about a further extended rise in prices for food and energy. I mean, on the food side, potash prices have gone up like a 1999 internet stock. Fertilizer costs are surging. So this food inflation is a real problem. Food is even a bigger weight than energy, and seldom have we had food and energy shocks at the same time. So you're correct, the sanctions are unlikely to dissipate, but it might take out some of that super high-end tail risk that will give you an inflation rate that maybe even be 10 or 11%, because the March numbers we get are going to show inflation likely year on year around 9.
Joe, always great to get your thoughts. Thank you. Joe Livornia of Natixis. Joe had mentioned the impact on food. I mean, food specifically, farmers are planting less, right? There's not enough fertilizer to go around. What we're seeing is not just the impact on food prices today in the next couple months, but it'll be in next year's crops, Tim. And I think that's the issue that not many people have sort of factored into their models.
I think that's right, and we talk about the cure for higher commodity prices is higher commodity prices. If you want a couple ag stocks, I mean, look at Intrepid IPI, which is a potash company, also has absorbed some significant consolidation in the space. I think if you look at where food prices are, I do think that you can also play this into some of the industrial stocks, whether it is a John Deere, whether it is a Caterpillar. I think if you because this gets into I think what you would do if we actually do see peace break out in Eastern Europe, and we're going to save that for a different part of the show. I don't think the trends that we see right now with commodities change overnight. And I think this is something, I've said this over and over, I think these are structural issues that haven't been addressed in terms of spending, CapEx and OpEx with core businesses in the space.
Guy?
I mean, if you think about it, the fundamentals in place, the structural problems in place were in place long before anybody 90% of the population could find Ukraine on a map. This just sort of sped things up, and I don't think they're going to dissipate. I think to Tim's point, when things hopefully, when peace does break out. So I think you stay with these names. Deere and Company, for example, since he mentioned it, trading less than a market multiple, very reasonable valuation, especially given their growth projections. So I think you can stay with those names regardless of what's going on out there in the world right now.
Yeah, and I'll just say lastly, I mean, we have a recession playbook, and it is those massive tech names, and it is these kind of recurring revenue software names, and that's probably what you go back to if that's the fear.